What's going on, guys? Welcome back to my videos on stock market basics. In today's video we are going to cover growth stocks, so let's jump straight into it. A growth stock is a stock that's expected to grow at a rate much quicker than the market average, and the company itself has still got a lot of scope to develop. They don't tend to pay dividends because whenever they make profits they reinvest that back into the company. So because of this, investors don't really expect to gain profit from dividends. Instead, they expect to make their money through capital gains. A classic example of a growth stock is Netflix. It started off as a small book company and now it's a transnational corporation and one of the biggest companies in the world. It went from a small company to a giant in a relatively short period of time. It's constantly getting into new lines of business and has much potential to grow. But if we were to compare this with Coca-Cola, for example, we can see that this isn't quite the case. So Coca-Cola cannot be classed as a growth stock, but Amazon is. Growth stocks can be found in any industry and any sector, but they generally tend to be found in the most innovative industries. They generally have a high price to earnings ratio, and whilst they may not necessarily be profitable right now, they are expected to be profitable in the future. Or in other words, their business is expected to grow. Because they don't tend to pay dividends, they can be quite risky because the only way to profit from them would be to buy the shares at a certain price and to sell them at a higher price later on. So this is all well and good if the company is hitting its targets and is meeting its expectations. But if the opposite case was to happen and the company did not meet its expectations, share prices can fall rapidly as investors begin to doubt the company's future. And this is a classic example of why having a diversified portfolio is very important. When analysing businesses, you'll realise that growth stocks tend to have a lot of things in common. For example, growth stocks tend to have unique products and innovative technologies, and they usually have patents, helping them have a competitive advantage over their rivals. And because they don't pay dividends and generally reinvest their profits back into the business, they can grow this and they can grow their intellectual property and increase their competitive advantage over their rivals. And this helps them develop newer technologies, newer patents, and keeps them one step ahead of the competition and ahead of the game. And because of their innovation, they tend to have loyal customers or a significant market share in their industry. For example, a software company that comes up with a new app can take the industry by storm for being the first in what they do or being the best. Let's just take a look at TikTok, for example. It's taken the world by storm. So now we have these big companies like Google, Facebook and Snapchat competing with the very small company that owns TikTok called ByteDance. So even though TikTok might not necessarily have been the first video platform of its kind, because it was the first to grow mainstream quickly, it's taken the market by storm. So just to recap, growth stocks are stocks that are expected to outperform the market. They don't generally tend to pay dividends, and because they have a high PE ratio, they can seem overpriced, but they might actually be undervalued if the company continues to grow fast. However, if they don't meet their expectations, share prices can witness a rapid decline. If you've learned anything from this video, please consider hitting that like button and subscribing to my channel for more videos like this. But that's it from me. Take care, and I'll see you on the other side.